Hello and welcome to another accounting video in which we talk about yet another intangible asset, goodwill. Goodwill is created in our books when we purchase another company and we pay for the price we pay for the company is more than the fair value of the net identifiable assets. So the net assets are assets minus liabilities. So whatever we can identify, whatever are clearly identifiable in the books, we look at the fair value as of the date of acquisition, the day we acquire that company. So basically what happens here is we need to revalue all the assets and liabilities, not what the company has in their books, but the fair value as of that date. And then we need to see how much we are paying. If we paid more than the net assets are worth, as of that particular date, we have created goodwill in our books. Basically, we have paid extra money for the goodwill that that company has created, which is going to help us run our business. What's the life of this goodwill? There was a lot of debate in the past in terms of what the life was supposed to be, whether it was an identifiable number or not. And FASB has finally said that it has an indefinite life, so we are not going to amortize goodwill. So we just need to go through the process of establishing the goodwill number on the date of acquisition, and subsequently we need to do the impairment test on that goodwill. So let's first do an exercise where we identify how much goodwill should be debited in our books. That is, we are the company who is buying the other company. So let's take a quick example, look at a quick example over here. Fred Moss, owner of Moss Interiors, is negotiating for the purchase of a gallery. The following balance sheet of this gallery is given. They've told us this company has the following assets, which is cash, land, buildings, equipment, copyrights. Liabilities are accounts payable and notes payable. And then they have equity. We're not concerned with equity. So our concern is with the net assets, which is assets minus liabilities. Usually, liabilities, those numbers are what they are. We don't make any adjustments. It's only the assets that you're concerned with. And usually the assets that you're concerned with are the asset with land, which is never depreciated. That company is carrying that asset in their books at historical cost. Now is the opportunity for me to revalue that land. The other assets, such as your building and equipment, property, plant, and equipment are depreciated and is subject to a lot of estimates. The estimates are the life of the asset, the estimated salvage value. So these are the carrying values of those assets in their books, and they may not be the fair value. So this is our opportunity to check that. So what we're being told is that land is undervalued by 30,000. So basically this land which they were carrying at 70,000, the fair value is now 100,000. Equipment is overvalued by 5,000. So equipment is 175 over here, and it should be only 170. They had overvalued it. And the reason they probably overvalued it is maybe a change in estimate, okay? We have agreed to pay $350,000. That's the cash price we are paying for this company. So $350,000. So let's do a journal entry and see how this is going to work out. So I'm doing this journal entry on December 31st, 2020, the date of acquisition. So I will start out by writing down all their asset names over here. So I have cash, I have land, buildings, equipment, and copyright. These assets are being acquired. I'm acquiring them. I'm going to create goodwill in my books. So I'm going to highlight this here for a second. What else am I getting? Well, I'm getting the good and the bad, right? The bad is the liabilities. I'm assuming they're liabilities. Okay. I told you the liability numbers typically, those are not going to change. It's 50,000, 300,000, it stays what it is. Then I also know that I paid 350,000. So the cash I paid is 350. Cash paid is 350. So this kind of seems a little strange that I have 100,000 that I'm going to debit cash, the cash I got from them, from their bank account, and then I'm crediting cash 350. So you could say the net I'm paying is 250, but we just go through the process of listing all their assets. Okay. Now, what did we say about land? Land, we're going to bring it into our books at 70 plus 30. That's going to be 100,000. So 70,000 plus 30,000 is 100,000. Buildings are 200,000. No change in buildings. I keep it at 200,000. The equipment, 175, I'm going to bring it in at 170. 175 minus 5 because I said they've overvalued equipment by $5,000. Copyright, nothing is mentioned, so I assume it's still the same number. That's 30,000. Okay. So now this number over here, in the journal entry, it is the balancing figure. So the balancing figure over here is $100,000. So I basically paid $100,000 extra over and above what the net assets of that company are worth in order to acquire that company. Obviously, because I think they have created a business model, a customer base, whatever it is, that is going to help me generate more revenues than what they have valued their net assets at. So this is $100,000 in the books of the buyer. Goodwill is the name of the intangible asset. This asset is going to stay in their books at original cost, but it is subject to the impairment test at the end of each year. It should be done on an annual basis. So this is a quick example, a very simple example of how we create goodwill when we purchase another company. When you get to your advanced accounting class, you're going to see a lot more complicated situations of how goodwill is created. So with that, we complete this exercise on how an intangible asset such as goodwill is brought into our books. In the next exercise, we're going to look at impairment of an intangible asset.